Good morning and or good evening. It's an interesting way to start a podcast. Welcome to Real Wealth Podcast. I'm Tom. I'm here in Melbourne, joined by Claire, who's in London.
Yep.
Hence the good morning. What time is it there?
It's 8:20 in the morning.
8:20. Yeah, very early. Well, thank you so much for joining us. It's a little bit after 5 here, hence good morning and good evening. Claire's joined us here today from Pengana WHEB to have a bit of a look into two key things we want to look at today are ESG, sustainable investing, as well as the principle of greenwashing and having a bit of a deeper look into what that is. So I'm also getting a lot of messages just saying don't mention the ashes. But we don't have to talk about that if you don't want to. Start off, if it's all right with you, Claire, welcome. Thank you very much for joining us. Just want to have a bit of a look into, for anyone who's not familiar with it, the concept of ESG, what ESG investing is and how that kind of delves into environmental, social, and proper governance.
Yeah, absolutely. So I'm going to take a bit of a spin on that question. I'm going to start by talking about what ESG is and then talking about what impact investing is as well, which is what the Pengana WHEB fund is doing. Cool. So ESG stands for environmental, social governance. And fundamentally, it's an analysis framework that examines kind of what a company is doing that impacts the world and impacts the people that it interacts with. So ESG traditionally looks at a company's own operations, so their own carbon footprint, how they treat their employees, how they treat the communities that they are manufacturing around, things like that. And ESG historically has mainly been used as a risk management framework. So it's just seeking to understand how those exposures can generate financial risk, political or litigious risk to that business. So ESG has become like a pretty massive kind of theme, I guess, within asset management. When you look at things like the UN PRI or the Principles for Responsible Investing, that is one framework which investors can sign up to say that they care about this stuff. And they've seen huge increases in assets under management that's been pledged towards responsible investing and looking at these ESG considerations.
Right.
I think it's really important to mention, though, that is, as I mentioned, distinct from impact investing, which is what the Pengana WHEB Sustainable Impact Fund is doing. So impact investing is when you are actually directing capital towards companies that are actively doing something good with their products or services. So a good way to think about this is if you think about Unilever, right? So Unilever often gets held up as a champion of ESG because they're really good at reporting on their own carbon emissions. You know, they look after their employees, they have quite good diversity on their board. And so Unilever has really good ESG. But when you think about the products and services that Unilever is selling, it's things like shampoo and ice cream. And although ice cream has solved lots of my personal challenges, it's not solving any sustainability challenges anytime soon, right? So we wouldn't invest in Unilever because they're not having a positive impact on the world. So what we're looking for is companies that sell things like solar panels or cancer therapies or, education solutions, things like that can actually have a positive impact on the world through the products and services and not just, looking after their own operations. Does that make sense?
Totally. And I mean, I'm hoping on the first one to sort of blend those two together, the ESG and impact investing. But would it be fair to say that the ESG is avoiding the bad and impact is pursuing the good? Or is that too broad?
No, I think that's a really good, a really easy to understand way of putting it, actually. Yeah.
Yes. Yeah. Well, I mean, that's my role here, is to take the very complex that you provide and try to make it digestible to the simpletons like myself. So on a personal level, ESG and impact investing, I take it, is very important to you. In fact, I do recall when you were in Melbourne most recently, you had a look at that specific example of Unilever to kind of make the distinction of the ESG versus impact investing. And, ice cream has its benefits, but for going back to when you finished up at Bearings, I think it was 2020, is that right?
Yeah, it was the end of 2020, yeah.
End of 2020, so interesting time, not just for you personally, but in general. Was there something specific about Pengana WHEB that drew your attention? Because I get the feeling that you had your pick of the litter. How did you end up choosing them?
Absolutely. I mean, the thing that really appeals to me about Pengana WHEB, well, firstly, it's run by a boutique, right? So it's a boutique impact investor in London. There's only about 20 people who work there.
Right.
And the entire DNA of the company has been built around sustainable impact investing. It's an important consideration when they hire people. It's a really big part of our culture, just living and working sustainably and in a way that kind of treats people well and looks after the environment. And so the opportunity to join a company which is really solely focused on this, and also specialists as well. They've been doing this since about 2009.
Right.
We've got a great team behind us. Ted Frank's our fund manager. He's been with the firm since it was founded, and this is all he's been doing. Seb Belo's a chartered environmental scientist, so he brings that kind of deep sustainability expertise to the leadership team. And then George Latham came from Henderson, where he was kind of head of their responsible investing unit. So between the three partners, the leadership team has a lot of experience in this area and is really well committed to sustainability.
So good team around you, and you mentioned they've been at it since 2009, which puts them in the highly experienced category. Does that sort of show how new impact investing is as a concept, that going back as far or as recently as 2000, it is fairly new, uncharted territory?
Yeah, absolutely. I would say that the Pengana WHEB fund and WHEB, the boutique that runs it, has definitely been ahead of its time. And that's had its challenges, of course.
Yes.
But yeah, I mean, I'd say that we've seen much bigger interest over the last kind of 3 or 4 years. That's really only been the time period where we've seen more funds coming out that follow this kind of mandate.
Yeah.
But yeah, I mean, when you think about the assets under management that are in kind of sustainable investing as a whole, and then impact investing within that, it's definitely a minority. I couldn't put a percentage on it, but I would estimate 10% or something. So it's definitely very new, emerging, quite niche, and it takes a lot of experience as well and expertise, because to be able to do this credibly, to be able to actually collect the data on what the impact is of a company's product, to understand it, to scrutinize it, to report on it in a way that's really, high integrity and isn't going to invite claims of greenwashing, like you said earlier. That takes a lot of expertise and confidence in what you're doing. And so, it's definitely a newer area, and I'm really lucky to be working at a firm that has been doing it for such a long time.
Yeah, fantastic. Well, that's a nice little segue into greenwashing, as you mentioned. So I think it's a concept that I heard about it a lot longer before I fully understood it, and I won't miss an opportunity to have someone give us a bit of a deep dive into greenwashing. The reason, well, it's always relevant, but the reason for bringing it up specifically today is that recently ASIC have had to pull up Vanguard for a fund whose exclusionary screens failed to acknowledge the use of fossil fuels. Are you already all over this?
Yeah, no, I've heard. Yeah, there's plenty of examples of asset managers.
I thought there might be. I thought I'll pick one, because if we went through them all, we'd be here for a week. And the defence they provided, there was never any intention to mislead, but Vanguard recognises it has not lived up to the high standards it holds itself, etc., etc. Sounds like one that we would have heard a lot before. So equates almost to, look, we tried, which, probably isn't great. So I would like to throw to you, if you wouldn't mind, to have a look at what greenwashing is, maybe in the context of this example or broader, however you want to go about it.
Yeah, absolutely. So at its most kind of basic level, greenwashing is where you're making claims towards a sustainable credential or a green credential that doesn't actually exist. So you're essentially, whether you mean to do it or not, what you're actually doing is lying to the people who are buying the product, in my view, because they're investing in a product that they think is going to be good for the environment, good for people, and they're making that investment based on claims that are actually false, because you're not actually doing the things that you say you're doing. And we've seen, as you say, high profile examples of companies getting pulled up on greenwashing, where either they haven't put the correct controls in place, or they have actively sought to mislead in order to drive investment in their product. And so, yeah, it's a really worrying trend. I mean, one thing that I will say is that it's kind of welcome that regulators are getting more on top of it now, because it means that we are getting more protection for the consumer. But the ideal solution is that companies just don't do it. I think for me, I don't think companies really intend to do it a lot of the time. I think what often happens, especially with like passive investing vehicles, so these are funds where you're just kind of tracking an index, and often you're using filters and screens and stuff to do that, as opposed to an active fund where you've got a human being like myself making the decisions. I think what often happens is that those passive funds rely on filters and screens, which can be quite black and white, and they're having to make judgments based on like percentage exposures, how much revenue do they get from this, from that.
Right.
And I think really what's happening is that if you rely too much on computers to do that, you remove a lot of the nuance. And so when you look at things like, these passive funds or these indexes that have claims of sustainability, you can see some really surprising companies make their way into them. I know the Dow Jones Sustainability Index, for example, at one point has had tobacco, military and defense companies in there, fossil fuel energy in there. And I think it's really down to the fact that, as I say, they're relying on computer screens and exclusion lists and things, rather than relying on a human being to actually make the decisions. So yeah, I mean, that's one thing I'd say is really important about the Pengana WHEB Fund, is it is run by a team, right, who are actually, looking really in depth at these companies and what they're doing, and making a judgment and being as conservative as we can with that, rather than just relying on, computers and screens and exclusion lists and things like that, which can be kind of prone to error, I'd say.
Yeah. So what were the three examples, sorry, from the Dow Jones that sort of snuck in that was surprising?
Yeah, so the Dow Jones Sustainability Index at various points has had, and I think even as recent as the end of last year, has had companies which sell tobacco, which are exposed to like military and defense spending, which sell fossil fuel energy, even like alcohol and things like this. Things that you wouldn't expect to find in a sustainability fund. And as I say, I think a lot of it is because you're relying on these screens, right? Computer, so maybe they get, I don't know, 20% of their revenue from tobacco, and your screen is for 25, and so it makes it through, right? So that's why it can be kind of, I think there's definitely a place for those passive vehicles, but I'd just say it's really important, like when investors are looking at those, to kind of actually look at what they own, and just make sure that it is what you expect and what you think you're buying.
So that's what I was going to ask, was, is there sort of percentage thresholds that they can just coast underneath to kind of fly under the radar, essentially, whereas a human, so if you look at that and you see tobacco, alcohol, that's a huge red flag, and you go, well, no, but that wouldn't necessarily happen if you're just cutting under a certain threshold.
Yeah, I mean, there will be, and it will vary depending on the fund or the index and the manager. For us, our absolute no is if a company has 5% of revenues exposed to those things. But to be honest with you, it's so rare, given our mandate to invest specifically in sustainable impact companies that, as I say, do things like cleaner energy and healthcare therapies and stuff. It's so rare that we actually encounter a company that has exposure to those other kind of less favorable things. But yeah, for us, our absolute limit is 5% of revenue. But for other managers, for these passive vehicles, that limit could be higher. It really will vary depending on the fund.
And 5% is pretty low industry wide, isn't it? Because Pengana, from what I've heard, hold themselves to a fairly high standard in that regard. Yeah,
exactly. I'd say 5% is low, and as I say, it's very unlikely that we encounter companies that have any exposure to these things. If they do, it's more like 1%. Honestly, it's super low.
So from the bad, flipping that around to look at the good, which is the tell me if I'm getting this right, impact data calculator. Is that close?
Yes, about impact calculator. Yes,
impact calculator. Yes.
Yeah.
So a pretty handy tool that came up again when you were in Melbourne, that can show for a certain investment, and there's a demo that was provided, which was for $1 million investment, you are offsetting X number of tons of CO2 emissions, and was tons of plastic waste, I think was one. Water usage, a massive one, which equates to the annual household water usage. The one that I pulled up actually had two categories, which were just sort of, I was hoping to get a bit more of a description about. One of them was improved healthcare treatment, and then improved well-being. They're just sort of fairly broad, which is understandable, but I was wondering if you could give a bit more insight into what they represent in that impact calculator.
Yeah, absolutely. So perhaps I'll just do a quick recap on the impact calculator. I know that you explained it briefly, but just to be clear, so this is this is a reporting framework which is on the Pengana website. You can put in how much you've invested in the fund, and it will tell you the positive impact associated with your dollar investment. So, like Tom said, it can be about renewable energy generated or CO2 reduction, things like that. And that's broadly in line with our 9 themes. So we have 9 themes, 5 environmental and 4 social themes. And the 2 that you've picked up on there, Tom, are healthcare and well-being. So you're right, they are quite broad. And the reason for that is because obviously within like healthcare and well-being, our investments can be quite broad as well. And what those individual companies are doing, like the impact they're generating with their products, can differ quite a lot. So within healthcare, if you were to kind of deep dive into what's within that category, I mean, you've got companies like Genmab, which are providing, as I said earlier, cancer therapies. You've got companies like Thermo Fisher and Danaher, which provide like life science diagnostics and tools. So they're actually supplying the medical industry and helping with like drug discovery and development, and helping us actually manufacture things like COVID vaccines, for instance. You've got companies like Icon, which carries out contract research for healthcare customers. So their customers are developing the drugs, and they're kind of doing some of the work for them. So it is super broad. And if you open our impact report, which has just been released, it goes into kind of more detail on the methodology as to how we came up with those 11 people. But it's probably too much detail for me to go into right now. But yeah, I mean, it's basically just capturing, and trying to simplify as best we can. All the different like companies and exposures we have within our healthcare theme. And similarly within wellbeing, of course, we have companies like HelloFresh, which so you probably know it's a leading provider of meal kits. So they're in our wellbeing theme because they are helping people eat healthily, fresh food. It's nutritionally balanced, it's calorie controlled, things like that. And then you've also got companies like Cooper, which is selling like contact lenses and things like that to help people see better. And they also even have exposure to like IVF, so fertility as well. So as I say, again, it's a very broad category, and the companies that are in it are doing different things, and we've just tried to distill that as best we can into a number that you can kind of get behind.
No, it's fantastic. It just caught my eye because I love the idea and the use of the impact calculator, and I can, in my own time, I can delve a little deeper into those. The other one, so you mentioned earlier that it's not without its challenges, which leads us into just looking at a snapshot of the performance of the last 18 months for impact investing. I suppose how it was that ethical investing sort of underperformed after matching or bettering for a long period of time, up until I believe it was sort of the beginning of 2022 calendar year. And then from that, where you see it heading in the future.
Yeah, absolutely. So you're right. So it's been a challenging 18 months or so. I think the thing to kind of bear in mind as we approach this conversation is that, as I said, we're impact investors. So we're only looking at those companies who have a product or service which solves a sustainability challenge. And there aren't that many of them in the context of the kind of global equity universe, right? So we say that our investable universe, which is the number of companies we could potentially invest in because they're delivering that impact solution, that represents only about 15% of the MSCI World Index. That's 15%.
Yeah.
So there are whole sectors which we don't have exposure to, like financials, fossil fuel energy, real estate, things like that, because they're not actually delivering those impactful solutions.
Yeah.
And what that's meant over the last 18 months is that we've seen, because of all this uncertainty, because of like high inflation, rising interest rates, we've seen pretty significant swings within the index of what sectors have been doing well and what sectors haven't. And so in 2022, the big thing moving index returns was fossil fuel energy. It doubled its weight in the index last year. And of course, we don't have any exposure to that, and no one expects us to. So that was a headwind to our performance last year. And this year, what we're seeing is a different challenge, which is that the companies that are leading index returns are these big tech companies like Nvidia, Microsoft, Apple, that are exposed to artificial intelligence. And you know, those, we call them the Magnificent Seven. There's 7 of these tech companies which are driving over half of index returns year to date, which is massive. And again, we don't have exposure to those because they're not considered to be like sustainability solutions. So yeah, I mean, I'd say like over the last 18 months, performance looks like it's been challenging, but when you actually understand what's behind that, and it's mostly the things that we don't own rather than things that we do, I think it starts to make sense. Because I think, you know, when people invest in our fund, obviously they're getting, you know, over the long term, we aim to outperform the index and also deliver a sustainable solution at the same time. But on a short-term basis, when you have these big swings in like what sectors are doing within the index, I just think it's important for investors to understand that obviously we don't have investments in those areas, and it's just not in our mandate. And hopefully it is short-term, because I personally don't think that those 7 companies are going to be driving all of, you know, the majority of index returns for the long term. I think that's probably going to be a thing of hype around AI when we look back on it, rather than actual fundamentals.
That was going to be my next question about the Magnificent Seven. Are they just going to get bigger and bigger, or is the bubble going to pop? But
I mean, I personally don't see how it can be rational that 7 companies drive the majority of index returns over a period of time. And I think a lot of it, there is some like fundamentals behind it. Nvidia, for example, was able to beat their earnings estimates by 50% because of the demand for AI. But I think a lot of it is hype as well for some of those companies, especially Meta, where I think the actual fundamental case for them succeeding over long term is a lot weaker. So I think that is short term. And I think most importantly, I think that over the long term, we're going to see much better share price performance from these companies that are delivering these sustainability solutions. Because when you think about it, like every piece of climate scenario analysis that exists from organizations like the IEA, from the UN, basically all of them say that we are underinvesting in cleaner energy capacity quite significantly. And we're not on track to meet our like Paris climate agreement targets. Meanwhile, population is growing, population is aging, which is going to require more and better healthcare solutions as well. You know, there's so much demand for these products, and so much in the way of like state level, country level commitments to meeting these targets, that I think over the long term, we will see really strong demand for the companies that we're investing in, really strong growth, and therefore really strong share price performance as well.
That's great. So we're anticipating a comeback for impact investing.
Absolutely. I mean, I mean, it's 18 months is for me, 18 months is a short period of time, like in the context of the economy, and especially when you think that a lot of these targets are set for like 2030, 2050. You know, you do invest in our fund with a long-term lens. And as I say, the fundamental drivers of demand are absolutely there. I mean, it's not just government targets and things either. Like companies are issuing their own ESG targets. They have investors like myself, all of the sustainability investors, pressuring them to report on their carbon emissions, reduce their emissions, you know, take better care of their employees, things like that. So the demand is absolutely there, and it's absolutely growing. And over the long term, I'm completely confident that we are going to see like really strong performance from this type of fund. But as I say, we can't help like short-term swings in sector returns. And I think at the moment it's particularly extreme because we have such uncertainty around the economy and interest rates and things like that.
That's interesting that do you sort of, in your role, do you find that you assume a sort of level of not accountability, but demanding accountability when you say you're requesting the reports and show us this and show us that? You find yourself holding them accountable.
No, absolutely. I mean, engagement with companies is a huge part of what we do. So, and we can engage with them firstly on the impact of their products. So maybe they've got a product which is, I don't know, 10% of their revenue, and we're like, well, it's a really great solution. Like, how are you sending the message out to your customers? How are you selling it? How are you pricing it? So we can engage them on like generating better impact through their products and reporting on that better. But we also engage on them on that ESG side as well. So what they're doing in their own operations, how they set a net zero target, for instance. That's something that we are committed to for every company in our strategy, that every one of them has to have a net zero target and be on the way to meeting it. So yeah, I mean, we speak to companies all the time, either on the phone. We vote all of our proxies. So I don't know if you know, but every year they have an annual general meeting where you have a number of things which you can vote on as an investor. Yep. A lot of companies like asset managers will outsource that to third-party providers, whereas we do that all ourselves. We have our own ideas about what's best practice.
Keep it in-house.
And and we write to the companies as well every year to explain like why we voted the way we did and to invite conversation. So yeah, we're always in contact with our companies and always encouraging them to do better, really.
That's cool. That's a cool side effect that you're sort of holding them accountable. So one more that I wanted to ask you about, just because I loved it from the presentation, was the 6th incarnation of the Industrial Revolution. And what I took from it, and please jump in and correct me, is we have the Industrial Revolution that we all know. And then since then, huge leaps forward that included, steam engine, development of steel and electricity, automation and or mass production, coming into more recently, IT and telecommunication in the 90s, a bit more tangible because I was actually around for that one, and trying to predict the next big one. So the 6th incarnation of the Industrial Revolution will be a sustainable economy.
Yeah, absolutely. Yeah, and the reason we think that is basically because of, like, when you think about the huge reorganization that's going to be needed of the economy, of supply chains, to actually meet our sustainability targets, like our net zero goals, our Paris climate commitments, to look after this Asian population, it's going to be massive. Like the scale of change, all the little tweaks and all the big, enormous changes that are going to need to happen throughout the economy, it's going to be massive. And so that's why we kind of think of it as the 6th industrial revolution. And it is, especially on the environmental side, it is an industrial revolution. Like, we have an overweight to industrials in our strategy, which is pretty consistent. These are the companies that are not only, delivering the like solar panels and stuff like that, although they're not technically in the industrial sector, but it's also, all the companies that have come up with solutions that help you to save energy, to save water, to save all kinds of resources. The decarbonisation of the world is really being driven by industry. And we think it's really exciting. We find loads of opportunities in companies doing all sorts of different things within industry to support decarbonisation, and we think that they have a really strong growth opportunity ahead of them. So yeah, that's why we call it the 6th industrial revolution.
Fantastic. So should we strap in for the next 5-10 years, or is it like 30-40 years?
I mean, as I say, net zero targets typically get set for 2050. Yeah. And I don't expect it to be like a big bang, like we see nothing for 20 years and then a big bang at the end. I think we're going to see consistent increases and acceleration of investment in these solutions. And so, yeah, I absolutely think it's going to be a long-term investment trend lasting, 10, 20, 30 years for sure.
Fantastic. Well, I want to wrap it up there because I've taken up plenty of your time. I also, selfishly, the origin of this was actually when you did come to Melbourne, presented, was fantastic. And I was fortunate enough to be on your table. And even when you were meant to be eating, we just hit you with questions. Did you eat anything that day? Or
no, I mean, I keep seeing people, they're like, you've lost weight. And I'm like, yeah, I know why. I was doing all these investor meetings. No one let me eat. But
tell them, sorry.
Yeah, it's lovely to speak to investors, especially like when I've gone all that way to Australia, like the other side of the world. I want to meet as many people as I can, right? And get their views and listen to them and stuff. So yeah, it's really great to meet you and great to speak to investors while I was there.
Well, fantastic to be able to, I thought, why fight with 30 or 40 people to get my questions in? I'll just book a one-on-one. Did you get, I'm pretty sure last time I saw you were going up and down the East Coast, events, presentations, and then New Zealand, and then, was it New Zealand and then home or something?
Yeah, New Zealand then home, yeah. I had a day in New Zealand, and then I spent 5 days, took time to see the North Island, which was really cool.
Yes, fantastic.
When you go all that way, you're going to see some of the country. I saw a bit of Australia, saw a bit of New Zealand. Yeah, it's great.
That's great, and something to enjoy before the dreaded 15, 18-hour flight home or whatever it is.
I mean, yeah, more like 24.
Is it?
Yeah. And I caught COVID on the way home as well, so that was an extra treat.
You're kidding.
Yeah, I know. COVID has not gone away. It's still very much there in the skies.
Okay, well, that's not a great review. I mean, I don't want you to think of Australia as the land of the country where they show you food and then throw it in the bin and you get COVID. Let us know if you're coming out again. It'd be fantastic to come to another presentation. Thank you so much for answering all our questions, and have a wonderful day.
Yeah, great. Thanks for having me. Have a great evening.
Thank you so much, Claire. Cheers.
Bye. Bye.
Yeah.